We all need to look out for a number of threats or evils when it comes to investing. If you don't, whatever small amount of money you have will be stolen, pilfered and swiped and slowly moved from your pocket to someone else's.
In this video, we're going to look at the enemies of investing, what you need to look out for, and some things you can do so that you're less likely to be a victim of these wrongs. Let's check it out.
Welcome to moneyinshackled.com, the investment and finance channel and website that sets you and your finances free.
That was Andy and I'm Ben, and if you like what we say, hit the like button and click subscribe.
Fees. Fees are a constant drag on your investment performance, and if not given the proper attention that they deserve, they will chip away at your little pot until there's barely anything left, whilst at the same time making the finance industry rich as the money is siphoned from your pocket into theirs.
The good news is that fees across the industry have been coming down and this trend looks set to continue. That said, here are some of the nasty charges that you can minimise with a little research and forward planning.
Platform charge. Most investment platforms will charge you a fee just to hold your investments. Some charge a percentage based on your investment pot and others charge a fixed fee. Whichever you opt for, we suggest that you never pay more than an effective 0.25%. Today, there's just no need to pay any more than this. Thankfully, a surge of new investment apps such as Trading 212, Freetrade and Stake have entered the fight by introducing zero platform fees.
Trading fees and FX fees. Trading fees are some of the worst charges because they often prevent you from building and rebalancing your desired portfolio, and therefore impacting on your investing behaviour in your effort to avoid them. FX fees are similar and will usually slice away at your money whenever you trade and receive dividends. While the more comprehensive platforms are allowing these fees to run rampant, often charging 1.5% FX fees and around £10 per trade, the new commission-free trading apps have eliminated them or significantly reduced them.
There's a hell of a lot more fees that investors need to be aware of, but that would be a video in itself, and we've got a lot of other stuff to cover in this video. Other major fees you want to watch like a hawk are transfer out fees, the bid offer spread when trading, a fund's ongoing charges figure, a fund's internal transaction fees, and advice fees. If you need help in picking the best investment platform that's right for you, we've gone ahead and done all the hard work for you. Head over to moneyinshackled.com and check out the best investment platform page.
Taxes. To put it nicely, taxes are a thorn in any investor's side. If we describe them accurately, no doubt we will be banned from YouTube for obscene profanity. On the plus side, in the UK we have some quite generous accounts that allow us to avoid the worst of it on smaller investment pots, such as ISAs and SIPPs. But there are still some god-awful taxes that are effectively stealing what is rightfully yours.
First, let us clarify our stance on taxes. We are pro-taxes as long as they are levied as a reasonable percentage on real profits. What we despise are taxes that are incurred on transactions, cash flows and real losses. For example, stamp duty on UK stocks is 0.5%. Why? The investor has not made any profit and yet the government feels it is okay to take a slice. The irony is that UK investors can invest in many foreign stocks with zero tax up front, incentivising UK investors to forgo UK stocks and trade international stocks instead.
Income tax on dividends is another tax that really grinds our gears. When a dividend is paid, the value of a company falls by the value of the dividend paid. Therefore, no wealth has been created for the investor, but the taxman wants a piece. This also encourages some companies to seek other ways to increase shareholder wealth, and therefore affects behaviour.
This leads us to the sickening dividend withholding tax imposed by many foreign countries. For example, France would deduct 30% from any dividend paid by French stocks to UK investors. Remember, a dividend is not real profit.
As an investor, you have limited means to reduce taxes, but there are still some weapons in your arsenal. Use ISAs and SIPPs where you can. You may want to avoid certain countries entirely if they have punishing dividend withholding taxes and/or transaction taxes.
Synthetic ETFs are a potential way of reducing withholding tax, but not all synthetic ETFs successfully achieve this from our research. If you're interested in learning more about synthetic ETFs, then search our channel page as we have done a few videos on the subject.
Moreover, spread betting is another way you can avoid tax, but probably isn't something you want to do until you've first maxed out your ISA. Don't forget, the goal should never be to solely minimise tax if it lowers overall return. The most important thing is to maximise profits after the deduction of tax.
What worries us is that nobody ever talks about what impact that these taxes have on long-term returns. It is widely recognised that stocks have returned 8% per year over many decades, but we've never seen any study or heard anyone talk about what returns an investor can expect after the deduction of fees and taxes.
Say an investor invested a lump sum of 10 grand over 30 years, believing he was earning 8% annually. The final pot would be a not too shabby £100.6 thousand. But in reality, the fees and taxes could take that 8% down to 5% maybe. At that rate of return, the final pot would be just £43,200, almost 60% smaller than what it should have been.
Inflation. Most people would never have thought that inflation is a tax, but it really is. Tax is usually collected, but in the case of inflation, it is an invisible hidden levy on your wealth. The reason that inflation can be labelled as a hidden tax is because the government indirectly controls it. They can increase the money supply seemingly at will, as demonstrated by the money printing to fight COVID and before that the credit crunch. They can raise and lower interest rates, and they can stimulate and slow down the economy through government expenditure known as fiscal policy.
Raising inflation brings money into the government purse because it reduces the value of government debt. It works like this: they raise inflation, the assets of investors get hammered, and government debt goes down. It is a transfer of wealth from us to the Treasury, a hidden tax, to help pay for the national debt.
To carry on the example from earlier, if we assume inflation on average is 3%, that would take our investors' real return from 5% down to 2%. That 10k investment would now only grow to 18k over the same time frame. It now doesn't seem like such a great return, especially considering the time it took and the amount of risk that the investor had to take.
Our tip to all investors and savers is to start considering your returns after the effect of inflation. This is known as the real return. Too many people only ever look at nominal returns. This means if you're one of the majority of people in the UK who only saves money in a bank account, you need to start investing.
According to Finder.com, only about 3% of people in the UK were subscribed to a Stocks and Shares ISA account in 2019. That is a shockingly low figure. We conclude from that the majority of people in the UK are getting rinsed by inflation.
Further, that 3% of people using Stocks and Shares ISAs will include people who are investing in investment products that are producing dismal returns, like bonds. Vanguard's Global Bond Index Fund has returned on average just 3.5% annually for the last 10 years, barely beating inflation.
Recently, we've been asked to comment on the rumoured changes to capital gains tax. The rumours are that the capital gains tax threshold will be lowered and the rate increased, a double whammy. Whether this directly affects you or not, let's be clear, if this change happens, it's totally unjust and unreasonable.
Capital gains tax does not make concessions for inflation. A property owner may be sitting on a large nominal return. Say for example, if a property value moved from 200 grand to 400 grand over 25 years. But the real return over that time frame is likely to just be inflationary, and so no real gain to their wealth was made. And yet, they will be expected to pay a high level of capital gains tax when they sell up. These sorts of policies are often vote winners, but only because most people don't understand the difference between nominal and real profits. In fact, most people, and even most politicians, have probably never even heard of these terms.
Bad advice. If all those threats wasn't enough, then bad investment advice will surely make your investment stack topple over like a game of Jenga. You will get bad advice when it's free and even when you pay for it.
When I was 16, I went to my bank seeking advice to invest a small amount of money. It was a disaster. I ended up losing half of it, and to top it off, I'd committed a cardinal sin of selling at the bottom in panic. Whilst technically I had been speaking to a qualified financial advisor, in reality he was just a salesman for the bank. I'm sure they did well enough out of my fees. Learn from my mistake and make sure you know who you're taking advice from.
Even the most honest advisor is likely to underperform the market, as the hit that your portfolio takes from their fees is likely to offset any edge they provide over using just passive index funds.
A financial advisor usually gets paid a percentage of the size of a pot that they manage for you. This means they are incentivized to have your assets in investments that they can manage themselves, such as funds. They're not going to encourage you to invest in things like buy-to-let property or physical gold bullion, as they can't charge you for it. Remember, there's usually a conflict of interest with any advice you get.
Groupthink. The next investment evil is groupthink. This will likely impact your own decision making and even the actions from paid for advice, whether that's financial advisors or fund managers. Fund managers will invest in line with everyone else, so they will loosely track the performance benchmark and avoid looking foolish.
Groupthink also impacts every decision you make. Debt is bad. Pay down your mortgage as fast as possible. Stocks are risky. Stocks are overpriced. Interest rates can't fall any further. Some of these may be true, but do make your own decisions. People are taught what to think, not how to think.
We've also found, and this doesn't just apply to investing, that the best, cheapest and most suitable product are not always the most popular or well known. Cheap products don't tend to have the marketing budget to reach a wide enough audience.
It's why you see so many adverts for CFD brokers. In most cases, these are not platforms that beginner investors should be using. But because CFD brokers often rinse their customers in fees, they have large profits to fund more advertising to rope in the next unknowing victim.
Question of the day: what other evils do investors need to be aware of? Let us know down in the comments. Thanks for watching. On this channel we talk a lot about personal finance, investing and all things money. And if you want to see more great content, please click the subscribe button below.
This is moneyunshackled.com. See you next time.